Hi everyone, so today I am going to be doing a new video, a stock analysis video on Apollo Global Management. So we're going to discuss how they make money, their earnings, free cash flow growth, net income, all of that. Let's get started. So first of all, I'm going to start obviously with the company analysis to actually how do they generate revenue? And they are specifically an alternative asset manager who their largest segment of their revenue is credit. And through its retirement services, Athene, its business model centers on earning management and performance fees for managing client capital, fees-related earnings, and generating spread income by investing insurance premiums in high-yield credit and originated assets. So a lot of these asset managers, they generally are the same thing. You have Blackstone, BlackRock, of course, KKR, which I covered, and Ares Management. So those guys, they essentially do more or less the same thing. Sometimes they're more real estate heavy, sometimes they're more insurance heavy, just kind of credit heavy, of course, like Apollo right now. And just more specifically, the asset management. So the fee related earnings, Apollo manages money for institutional investors, for example, pension funds, endowments, that's means for schools for Harvard or something like that, across three main pillars: credit. The largest segment focus on corporate loans, direct lending, structured credit, CLOs, and distressed debt. Private equity, they invest and acquire companies seeking high returns. Real assets, investments in real estate, infrastructure, and natural resources. Think mining as well. And then retirement service. Through its subsidiary Athene, like I mentioned earlier, Apollo provides retirement solutions like annuities. They make money by earning a spread, the difference between the high returns generated by investing these premiums in assets managed by Apollo and lower interest rate paid to annuity shareholders, and principal investing. This involves income generated from Apollo's own balance sheet. Investments included realized performance fees. So just to give you a basic idea of how they actually make money. Now, we're going to go ahead into the most recent quarter's earnings. This came out November 6th for Q3 of 2025. Q4 is going to come out literally tomorrow, but I just want to do a stock analysis video on it now. And we have actually a pretty good quarter. So the reported revenue was 1.15 billion, up 24%. Same time last year, EPS came at $2.14 compared to $1.81 in the year ago quarter. The reported revenue compares to the ZAC consensus estimate of 1.1 billion, representing a surprise 4%. And the EPS was a surprise of 13%. So altogether, really, really good. They did incredibly well on both fronts. Now, the next thing we're going to take a look at is simply Wall Street. And let me go over to future growth. For some reason, they don't have the future growth here on Simply Wall Street. They don't have some kind of projection just saying that it's 2.57 billion. Perhaps maybe for Q4 they will update it. So we'll get back to this metric, but we'll still cover the stock regardless. Now, the financial health of the company, I think is okay in general. You just have to be careful of debt coverage and interest coverage down here. It does highlight that, but they do have, of course, high debt. That's probably a lot to do credit and the real estate that's on their balance sheet. So you do have to be aware of what the nature of their business is, that it's always going to be pretty much debt fueled on how it works, right? Now, the next thing we're going to take a look at is DCF. And this is, I believe, Wall Street forecast is overvalued by 39%. When we check historical growth, I've never seen this. It's undervalued by 87%. Wow, we're looking at pretty much two extremes here. So I think Tipranks more or less so will have that clarification for us. And I believe it pretty much does. It's 132, it's a strong buy, 9 buys, 1 hold, 23% upside, target of 163, low of 136, currently trading at 132. So yeah, I could see where they're coming from with this. Their earnings are pretty good. Their EPS and their revenue is growing fairly fast, I would say, in general. Now, their net income is also, I would say, pretty good. 1.8 billion in 2021, now 4.2 billion. So yeah, I mean, it's certainly more than doubled during that time, and the net income has been good. They are GAAP profitable, which is exactly what you want to see from a company. And lastly, we're going to take a look at where the stock is trading at right now. And currently, we have 133 bucks a share, a 52-week low of 102, and then a 52-week high of 167. So more or less so, they're pretty much smack in the middle of it right now. If you wanted to be more safe, I would probably recommend to wait for that 52-week low. But regardless, I definitely want to cover for Q4 because it's literally coming out tomorrow. All right, thank you, everyone.